Hello everyone, welcome back. I got some really good ones for you today on this Friday, January 30th, 2026. A lot's been going on with those markets, specifically in the precious metal space, so that's what we're going to be focused on for today's video. You know, we've been over the target with regard to precious metals. You guys started this channel around like May of 2022 when gold was like 1,500. We've been fans of stacking physical precious metals for the long term since the inception of the channel. So, you know, woohoo for us, I guess you would say. Kind of an ominous sign, though, for broader markets and just the American standard of living in general. But hey, I'm glad that we've been fans of stacking physical for the long term, and it has served us well. So I'll get into my thoughts on what's moving the metals market. You know, if you ask 5 different people, you get 5 different answers right now. So I'm going to try to bring a little clarity to the precious metal space for you guys. But hey, you know, feels like just yesterday I was doing videos when silver was at 22 per ounce saying, when is silver going to wake up and smell the coffee? So it's good to see it. We're at triple digit silver. Feel like I've kind of missed the first half of the Super Bowl, you guys, because this is the first video I've done for the year. So apologies for leaving you guys hanging, but you know, it's time to lock in, time to get everything back on an even keel and continue printing for this channel. So been doing really well, you guys. The 4 asset classes we've been focused on for the last few years have been centered around weak dollar plays. So we like tech, specifically the Mag 7, the multinationals that actually do really well in a weak dollar environment. We've been focused on things like energy stocks. We have Chevron, Exxon, ConocoPhillips all around, up around 10% so far just for the year. Been focused on crypto, which that's been, you know, that's kind of a sore subject right now, but we will touch on crypto. So yeah, guys, we've been doing well. Mega cap tech, mega cap energy, precious metals, crypto. We've been over the target, you know, so good to see energy really catching up just in the last couple months too. I was saying, you know, back in November, December, I think the next shoe to drop is energy. Make those energy companies, make oil hated again, you know, make those energy companies hated again. We were looking for WTI crude to start moving up. We've been seeing that. So a lot of things to be thankful for, guys, but you know, against a pretty alarming macroeconomic backdrop. So it's not all sunshine and rainbows. You know, we're doing well in the precious metal space because the dollar empire is bleeding, you know, like a stuck pig. It's very leaky. It's melting like an ice cube on a hot summer day. But you know, we weaponized it, guys. We weaponized the beast system. We have not been deflationist over the last few years on this channel. I've not been coming out here like 90% of YouTube grifters telling you to like save cash, wait for the crash, and hide under a rock. Like we've been saying the polar opposite. We've been saying the dollar's going to weaken. You're going to want to stay out of cash, stay out of bonds, go in growth. Get some speculative tokens that mirror the collapse of the US dollar like Bitcoin and gold, and we've done very well. So with that being said, Happy New Year, and let's lock in and let's get after it. All right, so we got that 10-year yield right now. We'll start with the 10-year yield in the bond market. We always start with the 10-year yield because, you know, the bond market is the largest market on planet Earth. It kind of sets the tone for how the other markets are going to behave. So looking at that 10-year yield right now, that very important benchmark for market watching, we have it at 4.25%. Now, in the prior videos, I was hoping that that 10-year yield was actually going to come below 4%. Down into the 3s, you know, I was saying we'll probably see like 3.85, 3.95, something like that. That has not happened, guys. The longer end of the yield curve, despite the Fed cutting rates, the longer end of the yield curve is still pushing up on those yields. It's kind of like a situation where the Fed's trying to lower rates and lower bond yields and stimulate the economy, but the private sector, especially longer term debt, is trying to say, no, man, you're not going to give me a yield of only like 3% when, you know, growth might get me over the next 10 years. So I might get eroded by holding these bonds with growth. I might get eroded through inflation. So I'm going to demand a much higher yield than you would like me to. So it's kind of that tug of war between the Fed trying to pull the rates and the yields down, and the free market trying to kind of push those rates and yields up. You're seeing a little bit of that. So 10-year yield kind of banging around, but you know, at 4.25%, it's nothing to freak out about, guys. I would be a little worried if that 10-year yield starts to spike. Like, let's say it's 4.25%, but it's 4.5 tomorrow, like a 25 basis point spike. That would be freaky and very deflationary. So we would see the 3 major stock indices fall. Gold would probably fall. Bitcoin, oil, all those risk assets out to the end of the risk curve would start to come down if that 10-year yield, which is at 4.25% right now, were to spike up to like 4.5% in the coming, you know, days and weeks. But do I think that's going to happen? No, I think we're just kind of banging around between 4% and if anything, 4.25%. I'm still kind of looking for those yields to drift lower. That was Baby Love. She might want to come over and say hi, my cat. Come here, baby. You want to say hi to everyone? I don't want to get too distracted, but she might come say hi to everybody. So got that 10-year yield right now, 4.25%. Nothing crazy, guys. Like, it's a little higher than I thought it would be right now, but not really a big deal unless you start seeing that thing spike like 10, 20 basis points a day. That could be a little alarming. So the debt market's not really sending any flashing warnings right now. Gold is, though, and we'll get onto that in a moment. We had the DXY, that dollar chart at 97. So the DXY, a bit of a psyop because it's the dollar measured against other worth less than nothing fiat issued currencies like peso, won, rupee, yen, whatever. So the dollar measured against other currencies, the DXY sitting at 97 right now. Still weakening though, guys. So the dollar measured against other currencies is weakening, but more importantly, the dollar, like in absolute terms, is really weakening, and that's that gold signal. So we'll get to that in a moment. But that DXY hanging out at 97, nothing to write home about. We've been talking about that DXY moving below 100, moving lower and lower. I don't think we're going to see like a crash to 60 or anything like that, nor do I think we're going to see an insane move higher. I think we're just kind of banging around between 90 and 100, but over time I think that DXY over the next few months is going to just keep kind of drifting lower. So nothing that's going to be happening all at once, nothing that's going to rock the market's boat too much, but I do think over time that dollar is going to continue to weaken, both in relative terms and certainly absolute terms, which we've been seeing a lot of. So DXY at 97, dollars continuing to just kind of pretty weak, but not relative to other currencies falling through the floorboards yet, but pretty weak and worth keeping an eye on. We have the S&P 500 right now hanging out at 6,939, up about 1% year to date so far, so nothing too crazy going on with that S&P 500. NASDAQ we have at 23,461 today, again up about 1% year to date, so nothing too crazy going on with that mega cap tech. Dow Jones, same thing, up about 1% year to date. So not a whole lot of action in the stock market for January, guys. Pretty boring month overall. Just kind of what you got going on with stocks. We do have crude oil moving up. So we have crude right now hanging out around 66 a barrel. Still a lot lower than I figured it would have been, guys. One thing we did get wrong on this channel is my price target on crude oil back in like 2022 was like 150 a barrel. We didn't make it close to that. I think we topped it around 120 and tanked all the way to like 50. So I lost the script with energy, but I do remain tentatively bullish mega cap energy stocks. I've been saying that ad nauseum for years now, talking about Chevron, Exxon, ConocoPhillips. Those stocks are up about 15% so far this year. So it's good to see Chevron kind of, moving out ahead, Exxon, some of these energy companies, something you'll definitely want to keep an eye on. And we are advocates of owning some mega cap energy companies. Oil's very boom and bust. We're not in a boom right now. Kind of gearing up for one though, especially if that dollar continues to weaken. So crude right now hanging out around 66 per barrel. We have Bitcoin right now at 83,769. Bitcoin's been hurting, guys. I was hoping to see all-time highs for Bitcoin this year, but I don't know, that's like fading further and further out as we just go day after day below 100,000. I used to say in Bitcoin, every day above 100,000 is a good day. Like, count these days, man. Like, this is good for the long term for Bitcoin. But now, we've kind of lost our luster. Gold's kind of stolen the show. We see Bitcoin hanging out, like I said, right now around 83, 84,000. Something you'll definitely want to keep an eye on. I'm a dip buyer here. We stack those sats, guys. I'm not going to tell you how much, but I do think you should have some Bitcoin exposure. We are fans of crypto on this channel for the same reasons we're a fan of gold and silver. So maybe we'll get into that later, why the gold bugs and the Bitcoiners hate each other so much. Like, they're cousins, guys, and they should, they should get along better. So we're kind of into precious metals for the same reasons we're into crypto. It's that weaker dollar narrative, that sell America narrative. That continues to kind of play out. So I remain tentatively bullish on Bitcoin, and I wouldn't be surprised if sometime this year we hit 150,000, guys. So, fingers crossed, but hey, somewhere between 26,000 and 126,000. That's kind of where I'm looking at Bitcoin for this year. It's very hard to be discerned where all that's going to go, but I do know one thing: Bitcoin is definitely somewhere that you want to be in the face of these falling government-issued currencies. So, fans of Bitcoin, but lately, it's been kind of rough, guys. Not gonna lie, especially with every time I check like crypto Twitter, it's just a bunch of people complaining about gold and silver stealing all of crypto's thunder. So, I've always said in this channel, guys, crypto and precious metals, that's not an either or, that's an and both. So, the Bitcoin cyberpunks, they need to get on board with gold, and the gold bugs need to get on board with Bitcoin. It's not just a Ponzi, guys. They don't get it. Both of these things are sound money. Gold is sound money. Bitcoin is sound money. Why? Well, gold is your gold standard for sound money. Gold standard. See how gold is even woven into the things we say, like the figures of speech. It's very interesting. But gold is the gold standard for sound money because it's portable, fungible, divisible, tangible, scarce, useful, and indestructible. Bitcoin checks a lot of those boxes, but where it falls short in like indestructibility or tangibility, it makes up for in like divisibility and portability. So, where gold could use a little bit of improvement, Bitcoin's good at filling that gap. And where Bitcoin could use a little bit of improvement, gold's kind of there to back it up as the tier 1 base layer for the global economy. So, it's like peanut butter and jelly, guys. I believe the sum is better than the individual components. So I think you should have some gold, and I think you should have some Bitcoin. But how much of that? We'll get into that too in a minute. So, Bitcoin at 83,000, Ethereum at 2,600 right now. It's just kind of banging around between 2,500 and 3,500, just like for years, I feel like. But we're not as big of fans of Ethereum on this channel. We do prefer Solana, which might be worth taking a look at right now at 117. My price target on Solana is still $1,000, guys. Nothing's changed there. So at 117, dude, you're looking at 10x upside from here. Just something to think about. Throw trash at me when I'm wrong. I could totally be wrong. It's going to be hard for Solana to replace Ethereum just because Ethereum is a massive network. We're talking like a $500 billion network. Things like that are very difficult to displace, but if anyone can displace Ethereum, I think it's Solana, so you'll want to keep an eye on Solana. Other contenders could be like XRP, Cardano, your blue chip altcoins. Maybe own a little bit of all of them. I own a little bit of XRP, Cardano, Avalanche, got a pretty big bag of Solana. Not so much into Ethereum, but I do have some meme coins laying around like Pepe. So some of those meme coins on the Ethereum blockchain I do like. And then obviously Bitcoin, guys. So that's kind of your overview for crypto right now. And I'm tentatively bullish, but sentiment is really bad right now. So we're just going to have to see how it plays out. Moving on to that gold and silver, though. That's the real star of the show right now. And I got a good one for you guys because, man, I've been in the precious metal space for as long as I can remember. I remember when gold topped out at 1,900 in 2011, you guys, and I was actively trading precious metals back then. So it's been a long road for me with, buying and selling precious metals. So I think you're going to really like my hot take on what's going on. So if you ask 5 different people why gold is soaring, you're going to get 5 different answers. They're all right. That's kind of the conclusion I've come to. I have a list of reasons for you guys why gold, silver, and platinum is performing so well. And if you want to make this framework a little bit more nuanced, you could even apply like a percentage weighting. Like if I give you 10 reasons, well, maybe a couple of the reasons are like 20% of the overall reason. And then some of these reasons, like they're little, but they're still pressing and there. So, maybe we'll try to make this framework a little more nuanced. So let's dive right in, shall we? So gold is soaring because reason 1, central bank buying and reserve diversification. I would say that's like 20% of the reason right there for gold soaring is central bank buying and reserve diversification. What do I mean by that? Well, central banks, which are the bankers' banks, they're all buying gold and silver right now, which I could spend a lot of time just talking about that. But long story short, central banks the world over, whether they're the Bank of Japan, the European Central Bank, our Federal Reserve, even like the CCP's Bank of China, the People's Bank, they're all buying it, guys. The BRICS countries, the G7 countries, so our allies, our adversaries, all the central banks are buying gold right now, which is funny because Powell's like in the presser the other day when the Fed held rates steady, Powell's like, oh yeah, gold, we like monitor it, but we don't really care about it. That is just tells you everything you need to know about it, guys. Like, they set monetary policy, and they try to ignore gold. Like, and they even try to ignore the dollar. People were asking in the press conference the other day, why is it, Fed Chair Powell, do you see that the dollar is weakening? Like, what are your thoughts on that? He's like, oh, I'm not talking about the dollar. It's like, what's your job? If you're not going to talk about gold, you're not going to talk about the dollar. It's funny because that allows the Fed to say, oh, that's the Treasury, or that's, the banks, like the investment banks or the commercial banks problem. Like, go talk to them about it. But you see how this beast system works, guys, where you have the Fed doing their share of making a mess of the American people and global economy, the Treasury doing their share, Trump doing his with inserting all this policy uncertainty. You have the investment banks like Goldman Sachs, off doing private equity and printing fake money hand over fist. You have JP Morgan, the commercial banks, like JP Morgan, Bank of America. They all play their diabolic role in this beast system. And whenever, the chickens come home to roost in something like gold, showing that your dollar's collapsing, well, they all, oh, I don't know, ask that guy. And that way, it's nobody's fault, right? But it's all their faults, guys. And it is a beast system, okay? What moves markets? Fear and greed. Where does fear come from? The devil. Where does greed come from? The devil. It is a beast system. It is a satanic system that will continue to feed, whether it's on me to the middle class or perpetual war, right? So the beast system continues to feed, and investors have questions about why precious metals are, the canary in the coal mine, screaming higher, kind of demonstrating, sending a signal that dollar empire in real terms is collapsing. And then what do? Oh, I don't know. Go ask him. Don't look at that. It's just a shiny rock. It's just a volatile commodity, So the psyops are real, you guys. So we have central bank buying and reserve diversification. That's one of the reasons gold and silver has been doing so well. We have China and BRICS leading de-dollarization. So our adversaries, guys, Brazil, Russia, India, China, South America, they're getting out of U.S. Treasuries, man. Not overnight, but if I'm China and you're India right now, and we're talking on the phone, we're talking about how, what percent of Treasury, U.S. Treasury exposure we want to have, and it's looking like less and less every day. So pick another example. Like, let's say you're Brazil and I'm New Zealand. If we're talking to each other right now, we're both bankers in our respective countries doing our thing. We're both saying to each other the same thing. When you get rid of your U.S. Treasuries, what are you buying in place of it, And that's what you're seeing. If they're going to sell U.S. Treasuries, they're going to want an alternative, and gold's kind of taking that role right now. Bitcoin should be too. And what happens when they sell those U.S. Treasuries? Well, those U.S. Treasuries might go somewhere else for a while, sit in like maybe France, and then they end up in like, Namibia, and then they end up in Australia. But this is the point, guys, they slowly work their way home. Okay, all that inflation that we've been exporting to other countries, they've been holding it on their balance sheet in the form of U.S. Treasuries. As they sell that debt, it moves to the next guy, and it just slowly, as they all dump it and try to get rid of it, it just slowly works its way back to the United States. So all that inflation that we exported out kind of comes back in. We end up holding the bag. What does that look like? A ton of dollars chasing not a lot of goods and services. That's kind of your hyperinflation scenario. We're seeing a little bit of that going on, guys. So central banks, including our own Fed, which would never tell you this in a presser, but they're totally doing it. They're buying a ton of gold. Other countries' central banks are buying a ton of gold. Other countries are looking to get out of their U.S. Treasuries. See, this explains gold moving up and that dollar moving lower. Other reasons for gold and silver moving up, we have Trump policy uncertainty. So Trump's kind of, he's creating a lot of uncertainty with allies, like talking about like, no, we're going to just steal Greenland. We kidnapped that guy down in Venezuela. Now we're going to take Greenland while we're at it. Like, saying stuff like that injects a lot of uncertainty into markets just in general. And it also makes our allies upset with us. So it's just something to keep an eye on. We also have like the tariffs, right? The tariffs. Powell is saying, Fed Chair Powell is trying to blame inflation on the tariffs. The reason we're having inflation right now and inflation's running a little bit hot is because of these tariffs, but it's just a one-off thing, so don't worry. Remember in COVID when the inflation was just going to be a one-off transitory inflation and then it became entrenched? Well, once again, the Fed is telling you, don't worry, this is just a one-off price increase. Look into your hazy crystal ball, guys. These tariffs are stoking inflation. Powell's definitely right, but Powell's got a lot of blood on his hands too for the reason we've had so much inflation. It's just terrible policies coming out of the Fed, guys. We've been cutting rates. Why are we cutting rates? Somebody tell me why we're cutting interest rates right now. No, seriously. If you want to break the back of inflation, you need restrictive rates. You need rates to be above the inflation rate. The inflation rate is like 6%. In real terms, guys, let's be honest, it's probably like 8 or 9% right now. Then you need to have interest rates above the inflation rate. We're talking about like 10, 12, 14% mortgage rates. You know, a lot higher interest rates, a lot higher bond yields to get that inflation down. But Fed's sitting there driving those yields and rates lower, cutting rates, telling you like, oh, I don't know, the inflation is probably from the tariffs. No, dude, it's partly from you two over there at the Federal Reserve. So we have Trump policy injecting uncertainty, ally friction, whiplash, things like that. But we also have another reason for gold and silver moving up. We have late stage credit cycle dynamics. So guys, we have a credit cycle that started in 1981. It's getting kind of long in tooth. As we get towards the end of that, it kind of goes pathological. We got this K-shaped economy going on, got a lot of debt in the system. Markets are very frothy, inflated, corrupt. This is kind of that late credit cycle behavior, you know, because we had a credit cycle that started in 1981. We're still in it, guys. So we've had a lot of business cycles inside that credit cycle, but as that credit cycle becomes very long in tooth and mature, towards the end it starts to get really weird, which is why in my This Is How the Party Ends video I did like a couple months ago, I walked you through how the credit cycle is going to end and then what that's going to look like. So maybe take a look at that video, How This Party Ends, talking about what happens when you get to the end of a credit cycle. This one's like 40 years old, guys, going on 50, so been pretty old. And a lot's coming down the pike once we get off of this current credit cycle and usher into a new one. So gold and silver is kind of telling you something about late stage credit cycle dynamics. We also have geopolitical tensions, right? So Ukraine, Middle East, Venezuela, all kind of weighing on the global markets as they're like, man, this is just, you know, maybe globalization is coming to an end. Maybe we're not going to be as cohesive going forward. It's just going to be more like power players throwing their weight around. Like everyone's going to kind of be an island unto themselves. You know, maybe NATO's going to just completely break down as if it's, you know, it's already on life support. But, you know, so that's kind of driving precious metals prices, just broader geopolitical tensions, these wars, these rumors of wars. Kind of reminds me of Jesus talking about the end times when he says there will be wars and rumors of war. Hey, baby. We got baby love here. She's going to say hi to everyone. Oh, she's shy. She might be a little shy for the camera, guys. But this is baby love. She, you know, it's all for her, guys. It's all for her. But anyway, we got some geopolitical tensions driving gold and silver prices. We have just persistent inflation and monetary debasement. So low rates, guys. We've had low interest rates for a very long time. That's been a problem. In 2015, 10 years ago, when gold was $1,000 per ounce, the Fed was supposed to be normalizing interest rates, normalizing their balance sheet. They stayed behind the 8 ball on getting those rates and balance sheet normalized, and we're paying for that now. So it's, you know, it's kind of like your mom told you to clean your room like a week ago, and it's like today and she's about to come home from work and you haven't cleaned your room yet. Like the Fed pulled that with monetary policy and it really weakened the dollar. So, you know, I remember when gold topped in 2011 at 1900, and then we fell for about 8 or 9 years, but still that entire time, the only reason gold was falling was even though the Fed did QE 1, 2, 3, and 4 and printed a ton of money in the 2010s, we didn't see a whole lot of inflation in consumer goods. A lot of that money got sucked up into like tech stocks. A lot of that money got like exported. So we kind of got to like have our cake and eat it too, just for the 2010s. So all that inflation that we generated in the 2010s, the chickens are coming home to roost. We were behind the 8 ball in normalizing the dollar, and then COVID hit, and then they added 40% to the money supply. So that's another reason, guys, why gold and silver are moving up so much. They're on a delayed fuse from adding 40% to the money supply back with COVID. Then we also have speculators. So the good old speculators are in the room, guys. Once silver broke 50 per ounce, and I said in my last video, I think we got a lot of room to run here. This is only silver's 1980 high right now. So that tells me we have a ton of upside, because silver was 50 per ounce in 1980 and it's 50 per ounce in 2026. So look into your hazy crystal ball And boy, have we, went into a hardcore run. And I outlined that hardcore run for you guys, just like I did the AI bubble beginning when NVIDIA took off a couple years ago. I fired the starting gun for the AI wars. I fired the starting gun for silver breaking 50, and we blinked, and now we're at triple digit silver. And we were talking about $90 silver, $150 silver, years ago. So chickens are coming home to roost. I'm not going to sit here and act surprised. Kind of what you got going on. So just to summarize things, here's the reason for gold and silver moving up. Central bank buying and reserve diversification, China and BRICS-led de-dollarization, reducing U.S. Treasury exposure, Trump policy uncertainty, ally friction and whiplash, late-stage credit cycle dynamics, geopolitical tensions, low rates for way too long, speculators, the 40% we added to the money supply during COVID. There you go. Add it all up. You get a lot of reasons, guys, for precious metals, finally waking up and smelling the coffee. And that's the other thing, guys. I've been a metals bull for like a long, long time. So I survived that bear market in silver, where silver was just banging around between like 14 and 20 per ounce for like years and years and years. So we're making up for lost time, guys. I've been waiting for that, and it was on a delayed fuse, but now we're making up for lost time. So that's kind of what you got going on with precious metals. Now, what do you do? Because now we have metals correcting. So it's like the party over. Do I ape in now? Like, what do I do? Well, I'm just an armchair analyst on YouTube, so don't listen to anything I say. But with that being said, if you are 20% precious metals, which is overweight, but we would have advocated for that on this channel, you don't want to maybe sell some, draw down, back down to 10%. If you're at 10% for your precious metals portfolio, just sit tight. Okay, we don't really own. Look, man, I don't treat gold and silver like a trading vehicle anyway. That's why I was always saying to just stack physical gold and silver for the long term, slowly, just stackers. Stackers never lose, so you just slowly accumulate. So we were never about treating gold and silver like a trading vehicle. We were always about treating gold and silver like a high-powered savings account. So if you were overweight, sure, maybe you could sell some now, draw back down to like 10% of your portfolio being gold and just kind of hang on to that. If you were only 10%, which is perfectly fine going into this run, just stay 10%. It's a hedge. It's there to protect you. It's there for you when you need it. It is the sound money. It is the super-powered savings account. So just hang on to it. And if you had none, then yeah, you need to buy some, guys. But I don't want to hear, I had 50 grand, so I went out and aped it into gold at the top, and then gold's 3,200, and I've lost half my money. Like I don't want to hear. I don't want that to happen to you. So slowly accumulate. Just slowly do some stacking, and really just don't let the price inform your decision too much. For real. I know it's volatile, but it's really not, guys. It's really, and this is why. The dollar is volatile. The credit market is volatile. The world is volatile. Gold is just being a mirror for that. The reality is gold is the most stable asset on the planet. The reality is if gold's up 20% on the year and your stock market's only up 10% on the year, your stock market is down 10% in real terms. Gold is the measuring stick for the pool. Gold is the yardstick. So if you buy gold, you don't really get richer as the price goes up. And if you had 10 ounces of gold 5 years ago and you have 10 ounces of gold today, your wealth has not changed. You could sell that gold today and nominally get a lot more dollars, but guess what? The dollar weakened a lot. The gold was the yardstick the whole time. So when you buy gold, it can't really destroy you, but it also can't really drain you. It's like buying the yardstick. It's like buying the measuring stick for the pool. But we do believe in doing that. And that is a better alternative than staying in fiat-issued government currency. Because the dollar is not sound money. The dollar is currency, and currency is in many ways the antithesis of sound money. So gold is kind of like the anti-debt unit. The US dollar, that's currency, that's debt, that's a unit of debt. Gold, 1 ounce of gold, that's a unit of wealth. So gold is kind of doing its job, moving up as the currency weakens, and they print more and more currency, and then we operate in a perpetual vacuum where more and more must be printed in perpetuity just to remain where you are, never mind additional growth and productivity. So we're operating in a perpetual black hole, and that's sending gold higher and higher and higher, and silver higher and higher and higher, because the reality is gold's very stable. The supply grows at 1% per year, civilization grows at 1% per year, the gold dollar is very stable. An ounce of gold got you a tunic, belt, and sandals in ancient Rome, gets you a nice suit today. Value doesn't really change that much. It's actually the most stable asset on the planet. So that's kind of what you got going on with gold. I know that's wild, right? Because silver was like 20 per ounce a few months ago. Now it's like 120 per ounce. It's like, how do you call that stable? It's like, I'm telling you, the real volatility, it's in the credit market. It's in the thing. Gold and silver is just the mirror. It's just the abyss staring back at the dollar as the dollar acts pathological and you know, prints itself into oblivion and embarrasses everybody. So kind of what you got going on, guys. If you're underweight metals, buy these dips, okay? But I don't want to hear about it like, oh, well, now I'm down 20%. You're not down anything. If you bought an ounce of gold and you still have an ounce of gold, there you go. You're fine. So that's kind of how we like to, it's a game of ounces, guys. And stacking to us, physical gold, silver, platinum stacking, that's a different half from trading and investing. When I invest, I'm giving you money so that you go do productive jumping jacks, spin off a profit, and then pay me back. When I buy gold, I'm buying work not work that's about to be done. I'm buying work that's already done and stored. When you take delivery of a 1 ounce gold coin, the work was already done. They went out there with pickaxes or, you know, big dump trucks or whatever. They processed that ore, very energy intensive. They stamped it into a coin. They gave it to you. It's like a Mona Lisa. It's work that's already done and stored, not an investment that's promises to do work later. So the kind of my spiel on the precious metals, but we're enjoying the run, you guys. But I mean, you know, just let it happen. You know, don't stare at the price too long. Don't stare at that gold and silver too long either, guys. It's Medusa. All right. So we'll talk a little bit about the Fed, and I'm going to let you go because this video is getting kind of long. We got a new Fed chair coming in, Kevin Warsh. He seems actually a bit hawkish. You might hear some people say, oh, he's just going to cut interest rates like Trump says. And you know, in parentheses, he probably is going to do that. He's going to cave to Trump. He's going to kiss the ring. He's going to bend the knee. He's going to lick the boot. But historically, he's actually been pretty hawkish, worried about inflation. So, you know, maybe the guy's kind of a straight shooter as far as Fed chairs go. And man, that got to take that with a big grain of salt because they're all corrupt. Okay, they're all servants of Satan. But maybe Kevin Warsh isn't the worst of them. We're just going to have to see. But that's going to be your new Fed chair. We had the Fed leave rates steady at the last meeting a couple days ago. They need to be raising interest rates, but I don't expect them to do that. At least they're not cutting them, guys, because that would just be pouring more gasoline on the inflation fire. They left rates steady. Market seems to be okay with that. Still kind of digesting that Fed burrito, though. And yeah, it's been fun watching the Fed try to downplay gold and the US dollar, and it's been fun watching Powell dip, dive, duck, and dodge all these questions from the press conference. You know, it's just been funny to watch, guys. It's a real spectacle, all right? But, you know, not my monkeys, not my circus, right? We're taking the beast system that is acting in bad faith, and we're turning it against them. We're weaponizing it so that we can take care of ourselves and, you know, just stay discerned and stay out ahead of things, guys. So that's what we're going to keep doing. We're going to stay out ahead of things. We stay over the target. We're going to keep printing for this channel, all right? But it is difficult out there, guys. I can't imagine making 100K per year right now and just, you know, well, I mean, we are, right? If you're a millennial and you're making 100K a year, that ain't the gold standard anymore, man. That's only a few ounces of gold now. So you're going to need to keep pushing those prices higher. That's all I got to tell you. Because if wages stay the same and the beast system keeps feeding, your standard of living is going to be eroded. And that's kind of what we're seeing. And it's diabolical, but we've discussed it. Hope this video finds you doing well. Like, subscribe, comment, share, whatever. You guys are awesome. And we're just going to keep going, all right? Thanks for hanging out with me. Till next time.